Hi and welcome everybody to the next session at the DCS 2022, the ins and outs of container trading. This time a panel discussion, so not just a speaker or a keynote session, but we have a hopefully lively discussion in this small and illustrious round. We have from C-Cube, we have Denny joining us. Denny is Director Sales and Trading at C-Cube, I think based in the Netherlands, right, Denny?
Correct.
Yeah, based in the Netherlands, perfect. And we also have Andrea Monti joining us from Italy. He's CEO at Sogese. He's also heavily involved in container trading and leasing.
Good afternoon.
For all of you for who this is the first session, we will be recording this and we'll also be sharing the recording after the session. And we'll also take notes live as part of the session, so you can also read up on what was discussed, and of course also ask follow-up questions based on that. There's also I was told that there's also some poll questions on the right-hand side in your Jubilo platform, so you can also reply to those and of course use the question, and then we'll provide the answers to that. So the Q&A session a section on the right-hand side in your Jubilo, and we can then answer all of these questions at the end of the discussion. So we'll try to reserve ample time for that. Now, without any further ado, I hope you can all see my screen. This is our whiteboard solution called Miro, and we're just going to use that to structure the panel discussion a little bit. Without further ado, we're just going to jump straight into this and discuss the current situation on the market and its impact on global container supply and demand. As a first sort of starter, Denny, I'd be really interesting. What's your view? What's your assessment on what are current events that are impacting the container supply and demand significantly? What are trends? What does the market tell us? What do you see right now?
Yeah, so thanks Christian. So there are currently a number of events that have a significant impact on the container market and of course its outlook. We have the Russia-Ukraine situation, we have the China COVID recovery, global inflation pressure, interest rates escalation, but also food sourcing security risks, and these are all events that are causing uncertainty on the market. And before we touch a number of these events, I would like to make a small step back in time, basically to provide a better view of why we stand where we are today. As we already discussed in the webinar back in March, there has been a surge in demand for equipment in 2020 and 2021, basically driven by the effects of the COVID pandemic. And also the global supply chain was disrupted due to the lockdowns and labor shortages. People shifted spending money from services to goods. We were not going to restaurants, we were not going to hotels, but instead we bought tools to refurbish a room or in our house, or we bought new furniture. And all of this led to a significant increase in demand for containers, specifically for dry equipment. And we have also seen a sharp fall in the supply of equipment in the secondary market. And this drove resale prices also to historical record levels, and demand exceeded supply significantly. And to meet the consumer demand, shipping lines, leasing companies, but also trading companies and freight forwarders, they started to order record levels of new equipment. Almost 7 million TEU were built, and the global fleet size grew to approximately 51.4 million TEU, which was a 15% growth, while the annual growth over the last 20 years was only 4 to 5%. Earlier this year, we have seen easing restrictions in Western countries, and people are shifting spending money back again to services. And also trade patterns are starting to normalize, and the shortage of equipment in the marine fleet started to ease. The Russia-Ukraine situation has a significant impact on the world economy and is creating a severe energy crisis, as we all can see in the news. And we have, of course, the global inflation pressure, and the global inflation is most likely going to be above 6% this year. and will reduce consumer demand, what eventually will also impact the demand at shipping lines. And all of these events have basically impact on the global supply chain, the demand at shipping lines, and eventually the supply into the secondary market.
Okay, so what you're saying is basically it's almost a perfect storm. We see a drop in demand, and at the same time, sort of an unleashing of supply due to the lessening of supply chain disruptions, etc. So ultimately, coupling those two effects. Sorry for the light here. Coupling those two effects, you'd say there's an overcapacity of containers coming in the market. Is that what you're saying?
Yeah, I think when trade patterns are starting to normalize and we will see less consumer demand, I think we can say that shipping lines are overfleeted.
Okay, and what is your what's your assessment of what this means for the market in terms of availability of containers on the secondary market, price levels, etc.?
Well, yeah, so supply into the secondary market is primarily driven by the level of success from shipping lines. If shipping lines have high demand for equipment, we see less units being disposed into the secondary market. And when they have soft demand or they can replace equipment for attractive price new equipment, they will accelerate disposals into the secondary market. Well, considering all the facts that we just discussed, I think going forward, last quarter this year and next year, we can assume that we will probably see more dry equipment being disposed into the secondary market.
Okay, perfect. Is this, Andrea, is this also what you're seeing? Any other trends, any other sort of factors influencing this?
Yes. Well, let's say that I must draw a line between those countries that are actually, have been mostly affected by the rise of the energy cost, and those ones that are actually net exporters of this kind of resource. So in the second case, I would say that yes, the market condition have been penalizing the resale of containers, but not as much as the condition that we noticed on those countries which are net importers of resources. At the time being, I can see that the North American market still holds quite good compared to other countries. China is decreasing, but Europe is bad. Europe is actually bad, and that's because the fact that many companies have to face these high utility bills in some cases is forcing them to shut down. And if a company that's providing to the market the basic companies shuts down, it creates other premises for a new disruption of the supply chain.
Okay, what kind of new disruption do you mean?
Yeah, for example, well, let's say that in a market there are companies that are assembling stuff, and if one of these components is provided by a company that's actually very much aggressive on the usage and on the consumption of energy. Today, if we look at the utility bills, if you look at the weight that these utility bills have on the production lines for those companies that are actually, that are actually facing a big consumption of energy, the rise in the cost could actually force these companies to shut down for periods, or at least or in the worst cases forever. And in that case, that component will not be put in the market anymore and would cause problems to those companies which were assembling their finished product with that component. That's what I was trying to say.
Okay, gotcha. So what you're saying is especially if companies, sort of intermediate companies within the supply chain,
yes,
sort of go bankrupt, that will have effects on the overall supply chain. Yeah. Okay.
So this of course creates the premises for a minor demand of second-hand containers. There is less cargo circulating around, and there is less shipping demand coming from China and to Europe, and from Europe to other countries. You know, production, the production rates that we normally are used to check in metrics and statistics divulged by the news are very important. When production decreases, right after, immediately, all the circulation of cargo drops along with it, and of course there is less use of containers and less demand for shipping services.
Yeah, that makes sense. That makes sense, and I think that's also what we see all over the press, and also on exchange. Actually, when we talk to members, talk to users, that's also something that they're seeing. I don't know.
We also
slots are more than available, and
yeah,
availability
and
shoots through the roof.
From our point of view, there is also another factor. Given the surplus of second-hand containers on the market, right now we are noticing that many shipping lines are giving their priority to COC containers, therefore creating the premises for an accumulation of stock of those operators using SOC containers. So that's another problem. In the past, the excess of demand for shipping services would give the same priority to COC containers and SOC containers. Right now, it's not like that anymore. So any shipping line would rather use their own equipment in order to keep their stock balances between location, and only on a secondary level use the SOC containers, which is the asset that's actually feeding up also the exchange platform's operations.
Yeah, that's true. That's true. Although in some sense it's a sort of a return to normal, right? If I think back a couple of years, there were oftentimes a lot of stretches where shipping lines would prioritize COC, and hence sort of the marketplace had to balance this out with pickup credits paid by the equipment owner to the user, right?
Yeah. And this is clear from many points of view. We look at that by looking at the period of time the containers will stay on idle. We have some ratios. For example, we use the average time of containers, being released, staying on the ground. The ratio between containers on ground over containers released. This is some indicators that we use normally as metrics to feel the market conditions, of course, if we limit our views to the business that we currently run.
Yeah. And in terms of, so this leads into the sort of next question here. In terms of the shipping rates, the freight rates, we see a significant drop there as well, especially if you sort of follow the press and follow the published top line freight rate indices. What kind of impact does that have on sort of container sales, container trading?
Well, our activities has been, supported by shipping lines and MVOCC. And the fact that many MVOCC and many shipping operators have arranged themselves with their own fleet of containers, which was actually driving our demand for brand new and second-hand containers, really affects the demand right now, because many shipping operators right now found themselves with containers on idle in many locations in the world, and this of course freezes their expectation, their brightest expectation for the futures, as well as their investments. So what happens is that they will put new contracts on hold, and they will put on hold also existing agreements, just to look for the better. So this is a situation where we are looking at the I would call it a shift between a situation where everyone was benefiting from a high demand, to a situation where the expectation of the operators are not bright anymore. And when this happens, even if companies have their own operation, have their own market, they will just lower their investments and also their expenditure in the fleet growth. Also, there is another problem. Many operators have arranged their own vessels lately. Some of them, as far as I know, bought small vessels. Some of them have chartered new vessels. And this strategy, of course, brings along a lot of fixed costs, which are bearable as far as the freight rates are high. As far as the freight rates will allow the operator to recover these additional fixed costs. But once the rates fall down, what happens? It happens that these fixed costs shall be disposed, and it's not as easy as one may think.
Yeah. Is that also what you see, Denny? Sort of that sort of freight rates are, in a sense, if I sort of interpret this right, from Andrea, almost like early indicators of what's to come on the container market.
Yeah, I think Andrea had some excellent points here, and I think the current dropping shipping rates is really an indicator for less demand at shipping lines, and the impact on the secondary market is basically that we see more units being disposed into the market. I think the market is still extremely volatile. And market conditions are different in each region, but in general we see more units being disposed, softening in demand, and we see also that resale price for dry equipment are further declining, specifically in the Asia Pacific region, but also in Europe. And because of this negative trend and the uncertainty in the market, we see that buyers are reluctant to buy units on speculation. Which is also driven by the congestion levels at depots. What we also see is that sophisticated trading companies are trying to minimize their exposure by keeping their stocks at certain levels that establish them to still meet their customer requirements, but without the risk of being oversupplied and to remain with expensive inventory. And I think the trading community had to adapt themselves to rapid changing market conditions the last couple of years, and this year again. And in a declining market, it's important to stay on top of the market developments, and that really helped us to set a strong position in the market. In our projections last year, we calculated already that the current market conditions could be a realistic scenario for this year. And to minimize our exposure, CTP has been very successful in the renewal of expiring contracts. That's why our utilization is still high in the 98%. But this has also impact on the number of units that we are disposing into the secondary market. But that being said, with the annual average resale prices, we have also disposed relatively young units into the secondary market, as the resale prices were very attractive from a gain on sale perspective. And I think that we were not the only leasing company who accelerated sales for those units because the market conditions were attractive to sell these units.
Gotcha. Is there what kind of information sources or data points or the like do you use to make those strategies or those decisions?
So we use our own data. We are analyzing our data almost on a daily basis. But of course, we use consultants and reading the news to stay on top of what's going on in the world.
Yeah. Is that similar to you, Andrea?
Yeah, of course, we don't have that much access to consultants and worldwide databases because of course we need to contain the cost of the source of information. But of course, whatever is free and accessible to everyone is under our constant monitoring activity.
Yeah. Sorry, I'm just. That makes sense. Okay, cool. Now I was just asking because, of course, we just launched or just launching sort of insights on Exchange, which is a data product, and sort of from early feedback from our users who have been using this also a little bit longer already. We see that also those are interesting data sources and data points to include in those decisions. But of course, always with a big caveat. The information is not complete and nor not always 100,000% accurate.
No, but
I would like to add one thing here. There is also some opportunities arising from a depressed market. It's not always bad. There are chances to buy equipment at extremely competitive conditions. What I always say to my sales team is that we need to be prepared. When the market change, we need to train our operations and commercial department to take the right actions. That requires, of course, a lot of learning class. That requires a lot of time spent into the understanding of the market, and that would require time into the change. Into getting these people to change some habits, because when the market it's easy and demanding, you are used to do some moves. When the market change, you need to change your moves, but also your habits. Otherwise, you may put your company at risk.
True. No, very true. Very true. I think there's this old saying that in Chinese or in Mandarin, I think crisis is coupled from is another word for opportunity or something like that. So I think that's always important to have.
Yeah, of course. If you go straight with your culture and convictions and whatever you had in the past, you will crash into a wall if the market condition changes and you are not flexible enough to adjust yourself to the new environment.
Yeah. Okay, cool. And then maybe one last question, sort of here in this area of sort of the current situation. We've read a lot and are still reading, especially in Europe, sort of reports about port congestion, congestion in hinterland terminals, etc. That plus sort of an expected defleeting of shipping lines, etc. What does that mean for depot operations? I mean, Andrea, you operate a depot. What have you seen there? What do you expect?
Well, that's a good question. Let's start from the beginning. Well, we own two depots. One is a rail depot, which is based in Milan, and it's one of the main connection point for the traffic, going through the Silk Road. The other one is in Livorno, which is a seaport, substantially. What we noticed is that whatever was coming from in and out Milan right now is quite stuck, meaning that the number of containers stored in our depot in Milan has been increasing fastly and by a lot, day by day, so that we had to back off some requests. We have to return some requests for depot service agreements, and right now we are on alert. We are watching closely our depot conditions and make sure that our at least bigger clients will still have their own room for their equipment. Of course, we are in a situation where we cannot accept any additional new customers, unfortunately. While in Livorno, the situation is, getting close to a congestion, but still good for the moment. We're still able to, provide home to some containers.
Yeah. Is that also what you see, Denny? Sort of when you talk to depots, your sort of trusted depot provider?
Well, it's different by each region. Of course, we have a global presence, so we see congestion challenges in Asia, but also in Europe. And I think considering the number of dry containers that have been produced in 2020 and 2021, that could be problematic if shipping lines really start to accelerate disposals into the secondary market, and it might become a bigger challenge than it is already today. On top of that, we have also seen that some empty depots have been looking to attract other businesses due to low level of empty containers on their depots during the COVID pandemic. We see now that some depots in the United States, but also in Europe, are now also storing full containers and some even chassis, what reduces the space for empty containers. For the reefer market, we think the reefer market will be more sustainable. In the last couple of years, we haven't seen much of the flux like we have seen for dry equipment. And we also think that the reefer market will be more sustainable going forward, basically because of four things, and that's the growing world population, food shortages, but also because people are embracing a healthier lifestyle. And as I mentioned already in our last webinar, in economical challenging times, people still need to eat. And we might not buy new furniture, we might not buy new TVs, but we will continue to buy food. So we think that the reefer market will be more sustainable and has the highest potentials going forward.
Yeah, I think that if I am allowed to add something, there are two sides of this problem. For sure, let's say that the logistics related to the reefer containers will be resilient compared to that one of the dry containers, considering what has been described in the just now by Danny. The problem is that it is a destination, because still this material, this food, this temperature control goods will have to be stored somewhere before being dispatched to the end user. And today, unfortunately, but I want to remark this, the cost of keeping a cold store, functioning and well maintained is high, because you cannot just turn it on and off based on your willingness or needs. It has to be working all the day long, and the consumption related to the energy is high. It's one of the highest in the sector, so that's going to affect the cost of the storage operator, and that's going to affect its decision. It's I would say expansion strategy, because anytime you keep a cold room turned on, a huge quantity of energy will be consumed.
Agree. Yeah, I think sort of energy is a very, very hot topic, especially in Europe at the moment. So 100% agree.
It increased by 3 times in a year. It's something we're not used to, and that, of course, is going to be reflected also on any goods, because it fuels inflation.
Right. So and it will eventually reduce consumer demand.
Yes. Yeah. That's the point.
Yeah. Agree. Okay, super interesting. I think we could spend a couple more hours sort of discussing that, but unfortunately, time is running very fast, just like inflation. So we might need to speed up a little bit.
Inflation is faster right now, I guess.
Yeah, exactly. So we have to run to keep up. we have a couple of more questions here, but I know that there's also some Q&A sort of questions here, which I'd really like to cover. So I'm just gonna really quickly look at this and just ask you maybe Danny really quick, sort of what KPIs do you currently look at to monitor and also steer your business? And what were maybe key changes in your business operations that you've had to make?
Yeah, so from a sales and trading perspective, we are currently accelerating sales into the secondary market for units that become available for sale at the end of lease, and usually our equipment is 11 to 15 years old. And together with our customers, we are currently proactively working on alternative sales channels to reduce the pressure on depots. One example is that we have expanded our gate buy agreements with customers. And also when we are evaluating potential expiring contracts, we make strategic decisions to ensure that we get the equipment back in locations where we have stronger demand and where we can meet customer requirements. One-way repositioning has been an important part in this strategy, and digital innovations and online platforms such as Exchange really helped us in achieving these goals. Other focus areas are really compressing the M&R cycle and the sales cycle, and we are working together with all the stakeholders to find effective ways that will help and streamline our operations, what eventually will lead to a better service towards customers.
Gotcha. And what are sort of key KPIs that you look at to also monitor whether these initiatives actually work?
Sorry, one more time, Chris.
What KPIs KPIs or metrics or numbers do you look at in order to also judge whether those initiatives work or not? Like,
yeah,
what are your key metrics?
So of course we look at the per diem rates versus the sales potential and the sales price, and based on that data we make a decision whether to sell the unit, whether we're going to try to extend the lease, or we will focus on one-way repositioning. So it really depends on the numbers.
Gotcha. So it's almost like a discounted cash flow analysis of your current lease potential versus sale. Yeah. Okay. Is that also what you do, Andrea, or do you have a different sort of strategy?
Well, we are actually. I would like to remark that we are a worldwide company, meaning that we have operation worldwide. But still, most of our operation have been financed by our own produced cash. Mm-hmm. We do have investors, but those investors are looking for returns. So, in terms of KPIs, we are pretty much focused on those ones that would actually allow us to monitor the cash activities, inflows and outflows. We look at the average durations of receivables, the average duration of payables. We look at the stock rotation, the faster it is, the better it is. And we look also at the ratio between credit overdue and credit outstanding. And then we also have some, our company is very much, managed with the use of KPIs, because we are a small company, so the sensitivity to a lot of variables is still high, and we need to keep control over these variables. Some, indirect KPIs that would actually be good to monitor the production of cash are the number of containers on the ground versus containers released, the fleet utilization rate, which for us is around 90 and 95%, but that's because we also take into account the stock that we accumulate for sale. And we also monitor the average purchase price of our asset per location. So these are pretty much the indicators that we look in a specific moment, and also inside a trend line to take into account factors such as industry, seasonality, or specific highs and lows due to specific events.
Yeah. Okay. Cool. Makes sense. Thanks a lot for sort of giving us a bit of a sneak peek behind your curtains. It's very, very much appreciated. And I'd love to spend a little bit more time on that, but we only have 5 minutes left, so I'm probably just going to jump straight to the Q&A, because we already talked a little bit about sort of immediate forecasts. What do we expect? Sort of search and disposals and container fleet availability, etc. So let's go to the audience questions. First one, what tool do you use to track the number of days of containers on the ground? It was directed at you, Andrea. Is that custom built, home built, or anything you purchased?
That's another good question. You know, in the past we used to use a combination between our homemade software and Excel sheets. Right now we are developing our new IT system, and it's tiring a lot because we do a lot of things. The market is changing quickly. We have a lot of operation, a lot of restriction due also to tax regulation and stuff like that that we need to take into account. So yes, we are investing closely 1 million to develop our new IT system, ERP, I will call it.
Gotcha. Denny, what software do you use? It's probably your core leasing software, right?
Yeah, correct. We have our own software where we track the number of days that units are standing at depots. Last couple of years, we have really focused on creating efficiency in a workflow to reduce the dwell time on depots. One of the things we have implemented is digital innovations where customers and our own people are getting automated notifications for units that are standing uncollected or waiting for repair. So we have these units on the radar, and so we can act quickly and inform our customers better.
Gotcha. Okay, interesting. Thanks. Next question is, the words such as freefall and supply overhang have been used by many market forecasters. This drastic price reduction has started specifically in Europe. How much further do you see the market prices fall? So get out your crystal balls, and where do we see prices develop maybe until the first half of next year?
Well, looking at the number of dry containers that are available in the market and that have been produced last 2 years, we can expect that market prices will further decline next year for dry equipment. But it's difficult to say to what level. Prices are fundamentally driven by supply and demand, of course. And it also depends on new build prices ex factory. So it's very difficult to do a prediction where prices will go. But there will be some pressure going forward, that's for sure.
Yeah. Andrea, do you agree, disagree? Anything to add?
Yeah, no, I completely agree. I can only say that by doing due diligence with our customers, we have the privilege to see some industrial plants and many small vessel operators would forecast freight rates cut by 2/3 from now and for the next 3 years. So that means that in 3 years, vessel operators will expect freights to 1/3, 1/4 of the current level. And of course, the cost, the price of the containers will just follow this trend. I don't think that it will reach such low prices, but if we look at the long-term averages, we used to buy in 2018, 2017, 20 feet for 800, 900 euros.
Yeah, some room to go still. Downstairs. Yeah. Okay. And on the reefer side, maybe just sort of as a last question here, if you look at 2023, Denny, you were a little bit more optimistic here for the reefer side. What's your expectation here?
Yes, we will probably see some more reefers into the secondary market in 2023, but not to the extent like we will see for dry equipment. Basically, for other reasons we discussed earlier in the discussion. It's very difficult to predict what the market price will look like going forward. Based on our data, we see that the market prices for reefer containers have been much more stable than it is for dry. We haven't seen much of the flux like we have seen for dry equipment.
Gotcha. Perfect.
Now, in this
Andrea,
case,
maybe, yeah.
No, I have to agree 100% because we are net buyers of reefer containers, and I haven't seen sharp changes and in the last few months.
Okay, perfect. In the last few months, then I'll have to unfortunately cut us all short a little bit. I really thoroughly enjoyed this discussion. I think we could go on a little bit longer, but unfortunately the agenda says stop. So thanks a lot for joining in, for dialing in, Danny and Andrea. This was a pleasure and a privilege as always. To the audience, I hope you all enjoyed this. If there are any questions that have remained here, we'll try to sort of ask them by email to Danny and Andrea as a follow-up. To be also able to circulate those after the call. And yeah, have a good rest of the DCS. Please also don't forget to rate the session. There's a rating tool in Hubilo, so we know whether we should invite Danny and Andrea again. Yeah, happy networking. Have a lot of good times and good sessions here at the DCS.
All right,
Yeah, thank you.
Christian.
Thank you.